And this is where everybody's scratching their heads right now, is what the hell's going on? Has the cycle finished? That's the big question everyone debates all day. And for me, you can see what's happened here. There used to be this perfect 4-year cycle, and suddenly it's changed. Well, what happened here is we've added an extra year. In 2022, at the beginning of 22, rates were still at 0, and they extended the debt maturity by a year to 5 years. So we've got an extra year in the equation. So all of the debts that need to get rolled in 2026 and not 2025. So that's why we've had less liquidity than we've expected at this point. You know, the banana zone point in the cycle has had less liquidity. I only really found this out over the summer when I redid the maths on all of this and realized, okay, wow, they've actually changed the structure of liquidity here.
Every few years, the crypto market hits a moment where the data stops lining up, the narrative breaks down, and confidence turns into confusion. And right now, that's exactly where investors find themselves. Bitcoin isn't following the clean 4-year rhythm that everyone built their models on. Liquidity isn't behaving the way it should, and the banana zone, the explosive late-cycle melt-up Raoul has been tracking for years, seems delayed. But according to Pal, this isn't a failure of the cycle. It's a fundamental structural shift hidden deep inside the global debt system. For Raoul, this is not about vibes or speculation. It's about math. During his recent presentation at Solana's Breakpoint 2025, he explained that everything changed when global policymakers quietly extended U.S. debt maturity in early 2022. Rates were still at 0. The Treasury was trying to buy time, and by pushing refinancing from 4 years to 5, they effectively added an entire year to the macro cycle. That one administrative adjustment, invisible to most of the market, reduced liquidity across every risk asset in 2024 and delayed the blow-off phase investors expected this year. And this matters for crypto because liquidity isn't just another macro indicator. It is the oxygen of the entire asset class. Bitcoin, Ethereum, Solana, and the entire crypto market. All of it moves because global liquidity expands and contracts. Pal's point is simple. The cycle isn't broken. It's just running on a new clock. And once you understand that, the chop, the sideways grind, the hesitation, all of it makes sense. The system is building pressure, not releasing it. In this video, we break down Raoul's full macro framework, explain why the everything code still points to a massive liquidity wave ahead, and show how Bitcoin and the entire crypto market are positioned going into 2026. And before we roll the first clip, make sure to subscribe, especially if you want clear macro-driven analysis that cuts through the noise and helps you understand where crypto is actually heading next.
If you're serious about your retirement, stop letting big banks keep your money hostage. You need security, strategy, and zero paperwork.
This is the iTrust Capital Crypto IRA. It's the only platform you need to put real assets, gold, silver, and your favorite cryptos right into your tax-advantaged account. Stop paying capital gains tax on your growth. This platform is designed for investors who want full tax advantages working for them, with one low transaction fee and no monthly fees.
Have an old 401k or IRA with Fidelity, Vanguard, or Schwab. We handle the transfer process for you. Complicated forms. We even support in-kind crypto transfers.
Your time is too valuable for old, slow systems. You can sign up and start your transfer in just a few minutes, right from your phone or desktop.
Don't just speculate, grow. It is the crypto IRA you can trust. Tap the sign up button below right now to open your account.
Thanks for the support and enjoy the video.
So I use something called the Everything Code. I think most of you will be familiar with the Everything Code right now. And it's my understanding of how this all fits together from a very big picture to how it fits together into the business cycle, to asset allocation, where we are, all of that. And this has been very, very helpful for me. I based it upon the magic formula, which is GDP growth equals population growth, productivity growth, and debt growth. So that's how we understand what drives economies. Once we understand that, we can understand the messes we're starting to get into. Trend rate of GDP has been declining for decades now, for 50 years basically. As the population starts aging out, trend rate has been going down. The population is aging, and you can see from the chart here, it's the same trend. Older populations tend to produce less growth. Productivity, older people are less productive. So we have a decline in productivity over time as well. So this is driving this slower economy across the whole Western world, whether it's Europe, the US, or elsewhere. Then we start to see debt growth. Debt growth is the big problem that we've been facing for decades now. It blew up in 2008. So total debt to GDP in the US has been roughly stable, but that hides the story of what's really been going on. The private sector's been deleveraging over time. So they've been taking on less debts, and that's been a good thing. But that is entirely offset by the government that's been increasing its debt. And so this debt burden is the real issue that we're facing today. That is all driven by demographics. So I said we're going to zoom out. This is the really important story of why this is happening and why it matters to us, and it'll come down to how it makes us asset allocate into crypto as a sector. So that's the birth rate of the total population. The trend growth has been declining forever after the baby boomers came into the labor force. They've been slowly aging out. That whole trend rate has been also prevalent in the labor force participation rate, which is the working labor force in the United States. And we've seen the working labor force has been declining and follows exactly the births-deaths rate. So what we've got is ahead of us, out to 2040, nothing but an aging population. So that, if you think about it, means slow growth for economies, difficulty raising taxes, more expenditure for governments, and this is the mess that we're facing. This chart is the most important chart in all of macro, and most people don't understand it yet. And I keep bringing it up, saying, I know when people don't get it because it's not been copied and sent on Twitter all day. This is the labor force participation rate, and against it is government debt as a percentage of GDP, inverted. Basically, all debt has been accumulated to offset the working age population decline. So they're trying to bolster growth by adding debts. And right now, they kind of have broken, from 2008 onwards, they've broken debt growth. Debt growth is now just servicing of old debts, and interest payments keep accumulating. So this is the whole game we're in. This is why it's happening. Why we've got this indebted world is not because of government overspend based on whatever political party you like or don't like. It's none of that. It's just because we've got an old population. And that's the same in Japan, which has an older population, so they have more debt. Europe has older populations, so they have even more debt. And the US has a slightly younger population, but it's exactly all the same process. And you've got these mega trends. So the labor force participation rate just continues in this nice secular downtrend, and government debt to GDP keeps going up. When you look at it in a log channel like this, you can kind of project where we're going to go, which is what Japan did. If we continue as we go now, we will end up by the, let's say, 2030 at 160% of GDP in debt. So it just keeps going. And you can't really stop it because we've got this aging population. So how do we get GDP growth up? Well, that's a story for another day, the story of AI and robots replacing the demographics. But right now, we're in this everything code cycle. And that is the cycle of using liquidity to offset debt. So basically, what they're doing is printing money to pay the debt. That's like using a credit card to pay a credit card. That's the whole game we're in. This is the debasement of currency. This is the game why the rich get richer because they own assets, the poor don't because they have incomes. Incomes only grow with GDP, and assets go up by the rate of debasement, which is at least 8% a year, plus maybe an inflation rate. So that's the whole game that is being played at every government level right now. And we're seeing it again yesterday as the Federal Reserve go back to using the balance sheet again. It's all the same story. We've got $10 trillion of debt to roll in the US alone in the next 12 months. So, and I'll come on to the business cycle and how that all interacts, but this is the story. This is what drives number go up and drives adoption of the industry that we all know and love. Or maybe not right now because it keeps chopping around too much, but generally we do. And here's another way of looking at it. Here's the interest payments. The interest payments are what are getting monetized. And so total liquidity just follows the interest payments. So that chart tells you we've got around $7 or $8 trillion that we need to print just to cover the interest payments over the next 12 months into the end of 2026 when things calm down a little bit for a while. And this is the reason why the Fed are trying to get rates down, or the Treasury are begging the Fed to get rates down because they need to get rates down to the level of GDP growth, which is, let's say right now it's about 3%, 2.5% trend rate. They're going to have to get rates down to that, because if not, that number keeps compounding, because GDP is the economic activity by which you pay the debts and the interest payments. What we realize within this is the cyclicality of all of this. And this was an important thing when I suddenly realized that the business cycle had gone from variable lengths, and my job as a macro strategist and an investor was to figure out when the business cycle was going to peak and trough. And it's not an easy game, because some years we had, some periods we had like 7-year business cycles, other time we had 4-year. It was moving around the place, and then suddenly everything changed. It suddenly became perfectly 4-year cyclical, starting in 2008. And it was all to do, I found out after a bit of work, to do with the debt maturity. So 2008, we had a debt jubilee. They forgave all the interest payments and all the debts in all the major economies in the world. And when they did that, they restructured all of their debts. So I'm just going to grab some water. They restructured all of their debts, and they restructured them in the 3 to 5 year sector. So as they did that, they created this debt refinancing cycle where every few years they have to refinance all the debt, which requires liquidity, and liquidity drives the economic system. So it's no magic that the Bitcoin halving happened to be a 4-year cycle. It was just matching the economic cycle.
PAL's Everything Code sets the foundation for understanding why crypto behaves the way it does, not as a random, sentiment-driven speculation market, but as a high-beta expression of global liquidity. The demographic slowdown, the structural decline in productivity, and the relentless rise in government debt all intersect in one place: the need for constant monetary expansion. When the working population shrinks and tax revenue stagnates, governments don't cut spending. They issue more debt, and when the debt becomes too large, they must create liquidity to service it. This is the silent engine behind every major crypto cycle. And as PAL shows, we're now entering the phase where debt servicing costs alone require trillions in new liquidity. For crypto investors, this is the key turning point. Bitcoin doesn't rally because halving memes go viral. It rallies because the business cycle bottoms, liquidity surges, and capital flows into scarce assets. What Raoul highlights is that Bitcoin's price movements, even the dramatic spikes, become perfectly clear once you remove the long-term adoption trend and look at it relative to the business cycle. Bitcoin isn't in a recessionary environment right now, even though price action may suggest it. It's in a liquidity pause environment, the kind of environment that precedes the strongest upward moves in every cycle since 2008. This is why the next phase matters. When liquidity expansion restarts in full, the gap between where Bitcoin should be and where it is today begins to close fast.
We had this perfect 4-year cycle, and this is where everybody's scratching their heads right now, is what the hell's going on? Has the cycle finished? That's the big question everyone debates all day. And for me, you can see what's happened here. There used to be this perfect 4-year cycle, and suddenly it's changed. Well, what happened here is we've added an extra year. In 2022, at the beginning of 22, rates were still at 0, and they extended the debt maturity by a year to 5 years. So we've got an extra year in the equation. So all of the debts that need to get rolled in 2026 and not 2025. So that's why we've had less liquidity than we've expected at this point. The banana zone point in the cycle has had less liquidity. I only really found this out over the summer when I redid the maths on all of this and realized, okay, wow, they've actually changed the structure of liquidity here. So when we change it to the new 5.4 year where the debt maturity is, this is what we're going to get. So again, it gives you an idea that we're probably likely to peak out towards the end of 2026 in terms of liquidity, as opposed to this year. So probabilistically speaking, which is how I think about the world, we've got further to go, and we've got the big liquidity burst to come. You can see the changes coming. They're changing things like the SLR, the supplementary leverage ratio, that allows them to sell more treasuries to banks. We're seeing the Fed cutting rates. We're seeing changes in the money market. We're seeing the government ramping up fiscal stimulus. All of this is telling you that the big cycle still remains ahead. And I know most of us are impatient in crypto because we want things to go up quickly, but that's not how the world works. It's all based on the macroeconomy, and you just have to have patience because we've had this very choppy business cycle because there's been no real liquidity yet. Liquidity has been relatively slow. But what people didn't really realize, and I think we pioneered the work on this, is Bitcoin is a very macro asset. It's very understandable and easy to understand once you put it in a macro framework. It's not magic internet money that just is uncorrelated to anything else. It's actually super correlated. So you get this mega trend, which is the secular adoption trend driven by Metcalfe's law in Bitcoin, and it goes up and down, which we all know. And on a log chart, it doesn't look scary. In the real world, it goes down a lot and then goes up even more. But when you detrend that, it's actually the business cycle. So it is just driven by the business cycle. The reason it doesn't look, you have to detrend it, is because Bitcoin has all of the price spikes to the upside. So the skewness to the upside changes that. But when you detrend it, you've got exactly it. And what the Bitcoin is pricing right now is a gap that is not normal. It's pricing a business cycle that's going to recession, and I'll show you that that's not the case. So we're getting into the zone where things get very interesting, where the alligator jaws start closing. But just to show the importance of the business cycle and why ISM matters, it matters for every asset class. Everything on a year-on-year basis is the business cycle. People don't really understand this stuff. Once you understand this, it makes it much easier to understand how markets move, when they move, what they do. It's even easier when you know that we've got a predictable business cycle based on debt maturity. So if you've got that, you know what drives assets. Some lead, some lag. So crypto and technology lead. They actually follow liquidity. Other things like small caps and cyclical stocks, well, they fit with this. So here's the Russell 2000, which is essentially small caps, basically the same. If we go forwards to crude oil, same. If we go through to industrial metals, the same. Everything, literally everything in the entire investing world is driven by this cycle. Even things like the ETH Bitcoin cross. So think of this as alts. Alts are driven by the business cycle. So with the business cycle currently low, we haven't had alt season. And everyone's like, I can't believe they've robbed us of alt season. It's never going to happen. There's too many tokens. We can't have nice things and all of that bullshit we hear all day. It's not. It's just the economy's stupid, because what happens is when earnings go up, when the business cycle is strong, you have more earnings and you invest those earnings further out the risk curve. It's just really basic stuff. It happens for exactly the same as small caps, exactly the same with junk bonds, credit. They all operate in exactly the same way, and the business cycle has been subdued. Listen to Scott Bessent. He's telling you all day, as is Trump, is we're going to have a banner year next year. Why? Because they're going to jam the market with liquidity, and they're going to jam fiscal stimulus through as well. Yeah, if you think about it, the US is a service-based economy. They're going to get rid of tax on tips. That's a huge boost to people. There's like $1.5 trillion that will flow into the banking system just from that stuff alone, from the big, beautiful bill. Then we've got the changes to the SLR that allows maybe $3 or $4 trillion of credit creation from the banking system. We've got enormous amounts of this stuff lining up. Why? Because they wanted to win the election. You know, the good thing is, for once, we've actually got a macro hedge fund manager running the treasury. So I know how he thinks. He was a long-term global macro investor subscriber. I've known him for 20 years. And he understands the game, which is jam the business cycle going into the elections. So we've got that. We've got the debt to roll. It's kind of stacking up, and it tells you your beloved, or our beloved, alt season is still to come. Bitcoin dominance, the same thing. It's driven by the same thing. It's much like when the economy's slow, people tend to be in treasuries. When the economy picks up, they go further out the risk curve in different types of credit. It's all the same cycle. So it's a very macro asset. And here's the chart of the ISM versus Bitcoin, and you can see the peaks and troughs correlate well. So are we at a top, which is the thing that people bleat on all day on Twitter, with the top of the cycle? We can't be, because we're not topping in the ISM. In fact, we've not even gone above 50 yet, so we've not had economic expansion. Main Street has been struggling. They need rates to come lower. They need fiscal stimulus, and that's all to come. So probabilistically speaking, the business cycle lies ahead of us, and it should be quite rapid. So when we start looking at forecasting models of the business cycle, here's the interest rate model. That suggests to us that the economy strengthens fast and quite dramatically in the next 6 to 9 months. So that's good for altcoin season, that's good for crypto, that's good for all risk assets.
If Raoul Pal is right, and this cycle has been structurally elongated by the shift in debt maturity and the delayed liquidity impulse, then the implications extend far beyond 2025. It means the crypto market may be entering an era where business cycles stretch, liquidity waves last longer, and corrections become less synchronized with the old 4-year rhythm. In this scenario, elongated cycles become the new norm, not the exception. Future liquidity expansions could run hotter and for longer, with deeper buildups before each blow-off phase. For investors, the key shift is psychological. Patience becomes a competitive advantage, and market tops become far more dependent on global liquidity levels than on Bitcoin's internal halving mechanics. If this is the path we're on, the coming years likely hold larger, slower, but more durable upward trends across the entire crypto complex. But there's a second, equally plausible scenario that deserves examination. The possibility that this elongated cycle is a one-off anomaly, a ripple effect of extraordinary COVID-era fiscal and monetary policy. Under this interpretation, the market hasn't changed its fundamental structure. It simply absorbed an unprecedented shock in 2020 to 2022, and the extended debt maturity was policymakers buying time, not engineering a new macro regime. If this scenario plays out, crypto could snap back to the classic 4-year rhythm: boom, bust, consolidation, expansion. This view suggests we still get a strong liquidity-driven rally ahead, but future cycles return to clean symmetry, with halving events continuing to serve as reliable markers. For long-term investors, this would anchor price expectations more closely to historical patterns and make macro timing more predictable. The final scenario is the most subtle, and arguably the most important for the next decade: the maturation of crypto itself. Bitcoin ETFs, institutional custody, the rise of Solana and Ethereum as settlement layers for mainstream applications, and the gradual integration of crypto into corporate treasuries may all contribute to the dampening of extreme volatility. If crypto is now structurally larger and more liquid, then the famous euphoric banana zone blow-offs could weaken over time. Tops may still occur, but with less vertical acceleration and more controlled distribution phases. This doesn't imply lower returns, only that returns may compress and rallies may become more staggered as institutional flows dominate retail mania. In this world, investors shift their expectations from parabolic spikes to multi-year compounding. Each scenario leads to a different interpretation of the moment we're in: a stretched macro cycle, a temporary post-COVID distortion, or a mature market delivering more stable structures. But what they all share is a single through line: crypto continues to absorb global liquidity faster than any asset class in history, and the structural forces behind adoption remain intact. That's why understanding Raoul Pal's framework matters. It doesn't just tell us where we are, it helps us understand what comes next. If you found this breakdown valuable, tap the like button, subscribe for more macro-driven crypto analysis, and let me know in the comments which scenario you believe defines the next decade of crypto. Thanks for watching, and I'll see you in the next one.